Hey, welcome to another video in the IGCSE Accounting series. Now, this one is going to be on the treatment of year-end adjustments in the financial statements when you prepare the financial statements. So before you continue watching the video, make sure you are thorough with the topics like preparation of your basic financial statements, and then you need to know about the accrual and prepayments. You need to know about the bad debts and doubtful debts and the depreciation on assets chapter. Once these chapters are clear, you've understood them, this chapter will be much better, will be much easier. You'll understand this chapter better and you'll be able to implement them in the questions better. But before we continue, don't forget to subscribe to this channel and press the bell icon. Also, we have introduced a new course on IGCSE Accounting that gives you access to self-explanatory notes, solved exam type questions, and a discussion forum where students can discuss their doubts, and all doubts will be personally cleared by me. So all of this for just $99, where you get access until June 2021. If you are interested in the course but you're not sure about paying for the course, make sure you go to the course and watch the free lessons available. 2 chapters are available for free preview. You can watch them, you can have a look at them and then decide whether you may want to pay for the course or no. Now, before going further, you need to remember one very important point. Every adjustment outside the trial balance will always have 2 effects. One effect in the income statement and second effect in the balance sheet. On the contrary, any item inside the trial balance will always have only one effect. It will either go in the income statement or in the balance sheet. But for the adjustments, it always appears both in the income statement and the balance sheet. Make sure you keep this in mind. If you don't give this double adjustment or double effect, your balance sheet won't match at the end. So our first adjustment will be closing inventory. Now, what is closing inventory? Stock lying unsold at the end of the year when you're preparing the balance sheet date. Now, the stock that is lying unsold is already included in the purchases. But since matching principle requires us to match our expenses or cost properly with the revenues, we will have to deduct this amount from the purchases so that we arrive at the correct cost of sales. So in the income statement, this will be deducted from the cost of goods sold. And what about balance sheet? Now on the balance sheet, our closing inventory is our asset. So in the balance sheet, under current assets, we will be showing our closing inventory. Let's have a look at the example. So in this example, we have some details. Opening inventory, purchases is given, and at the end of the trial balance, after the trial balance, there's closing inventory of 25,000. Let's see how do we treat this in the income statement and the balance sheet. Now in the income statement, if you realize, when calculating the cost of goods sold, this is deducted to arrive at the net cost. Okay. And in the balance sheet, closing inventory is shown under the current assets section. Now, the next adjustment is on accrued expenses, also known as outstanding expenses. Understand the meaning of accrued expenses. Accrued expenses means expenses that were incurred. We were supposed to pay it before the year end, but we did not pay it. When preparing the financial statements, it came to our notice that this much expenses were supposed to be paid, but is remaining unpaid in cash. Now, what would be the treatment? If it was paid, it would have been included in the trial balance, right? But our actual payment of expenses should not affect our income statement. Going by that logic, you have to manually add the amount of unpaid expenses to your expenses in the income statement. In the balance sheet, now these expenses which remain unpaid are obviously business liabilities. Now in the near future, you will have to pay these liabilities in the next year. So from balance sheet point of view, these amounts will be shown in the current liabilities. Let's have a look at the example. So we have 2 expenses here, electricity and rent inside the trial balance. At the end of trial balance, we have electricity accrued of 200, which is nothing but outstanding electricity expense. Let's see what happens in the income statement. Now in the income statement, if you realize, we picked up this 2,500 from the trial balance and manually added 200 to arrive at a total of 2,700. Why did we add it? Because this was supposed to be paid, supposed to be included with the electricity charges, but since it's not paid, we'll have to do it separately. Now rent, 12,000 has been picked up from the trial balance. Okay, now going to the balance sheet. In the balance sheet, obviously this will be a current liability. So under current liability, the amount remaining unpaid has to be shown as a accrued electricity expense. Next one is a prepaid expense. Opposite of accrued expense, prepaid expense is when a business pays expenses in advance before it is actually even due. Now, just because you've paid an expense in advance doesn't mean that you will show it as an expense in the income statement. In the income statement, you're supposed to show expenses which belong to that year, which are supposed to be paid in that year, not which you've actually paid. Okay, now what do we do in the income statement? How do we treat it in the income statement? You will have to deduct it from the expenses paid so that we arrive at the net expenses. In the balance sheet, any expenses paid in advance will be an asset for the business because the benefit of these expenses will be received in the future. Okay, so that will come under current assets. So having a look at the example, we have insurance of 2100 inside the trial balance and rent of 12,000 again. If you look at the additional information, it says $300 was paid in advance for insurance. Now this 300 is already included in the 2100. So we are not supposed to show this entire 2100 as expenses in the income statement. So when preparing the income statement, you'll have to deduct the 300 and show only the net 1800. And rent obviously 12,000 from the trial balance. Going to the balance sheet. In the balance sheet, this 300 will be shown as a current asset because the benefit of this prepaid insurance, $300, will be received in the next year. Going to the next adjustment, we have accrued income, wherein the business is supposed to receive some income. It was supposed to receive some income but did not receive it in cash. The income has accrued but not received in cash. So what do you think would be the effect on the income statement? We'll have to add this income manually to the income statement under other incomes, because if it was paid, it would have been included in the income statement. But since it is not paid, we'll have to add it so that we follow our matching principle. And what about balance sheet? Now, any amount receivable not yet received, the business is going to receive it in the next year. Hence, it's a current asset. It's an asset of the business. So let's have a look at the example where gross profit is already calculated at 50,000. Commission received inside the trial balance is 4,500. Now this is what is already received in cash, 4,500. Additional information is given, $500 was accrued but not yet received. So in the income statement, whatever I've received, 4,500, I'll have to manually add to that $500 to make it a total of 5,000. Now this is the total commission for the year. Okay, and in the balance sheet, obviously it will come under current assets, amount due to be received but has not been received. We'll receive it in the next financial year. The next one is on prepaid income, also known as unearned income. Now what do you mean by unearned income? What do you mean by prepaid income? Income that is not yet due to be received, we should not have received, but we have actually received it in cash. We've received the income in advance. Now, since we've received the income in advance, this amount is already inside the trial balance. It's included in the income, but it should not be included in the income statement because it does not belong to the current year, and hence we will have to deduct it from the income. Anything received in advance, we are holding someone else's money in advance. Obviously, this amount, either this amount is payable back to them in near future, or we'll have to deliver equivalent amount of goods or services. So it's a business liability towards them. Let's have a look at the example. Gross profit 50,000. Now rent received during the period was 5,400. Now this includes 600 that has been received for the next year in advance. It should not have been included, and hence in the income statement we will have to deduct 600 and show the rent received at 4,800. In the balance sheet, this will be a current liability. We are holding someone else's money in advance, and hence it's a liability towards them on the balance sheet date. So 600 in the current liabilities. Going further, coming to bad debts. Now what do you mean by bad debts? Customers' amount that is not going to be received in future. The debt has gone bad. That's bad debts. Now obviously bad debts is a loss. It will be shown as an expense in the income statement, and bad debts amount reduces the amount that we will receive from our debtors. So in the balance sheet, we'll have to reduce it from our amount of debtors or amount of trade receivables. Now let's have a look at the example. Inside the trial balance, we have a bad debts of 900 and a trade receivables of 11,000. Apart from the bad debts 900, there's an additional amount in the included in the trade receivables of $400, which will not be received anymore. Now there's a difference between the bad debts inside the trial balance and bad debts outside the trial balance. Bad debts inside the trial balance was already known before we started preparing the financial statements. Hence a journal entry was already passed for it. But bad debts outside the trial balance indicates that when preparing the financial statements, this amount came to our notice then, and hence the entry is not already passed in the books of accounts. So going to our income statement, obviously the bad debts from the trial balance will be picked up at 900. To this we will add additional bad debts 400, which is included in the trade receivables, not yet adjusted in our books of accounts. We will add additional 400, and that brings us to 1300 of bad debts total. And the balance sheet, this 11,000 includes 400 bad debts, but this 400 is not going to be received anymore in the future, and hence we will have to deduct it from our trade receivables to show the trade receivables at a net amount of 10,600. If you notice here, bad debts inside the trial balance, 900 is only picked up at one place, that is the income statement. But bad debts outside the trial balance has an effect at two places in the financial statements, one in the income statement and one in the balance sheet. This is what I was telling you. Any adjustment outside the trial balance will always have two effects for the balance sheet to match. Okay, apart from bad debts, a business could also provide for provision for doubtful debts. Now, provision for doubtful debts could have three scenarios. One, where you have to create a new provision during the year. Second, where you have to increase the existing provision. And third, where you have to decrease the existing provision. Let's have a look at the first one. Now, what is doubtful debts? Doubtful debts is an estimated amount that a business may lose by way of bad debts. Okay. So let's say this is about creating new provision. During the year, we want to create new provision. When we are creating new provision, we feel that estimated amount may not be received from out of the debtors. A certain amount may not be received, and hence it is an estimated loss or an estimated expense. So that amount of doubtful debts will be shown as an expense in the income statement. In the balance sheet, you will show the debtors at a net amount after deducting your provision for doubtful debts, because balance sheet should show the net amount that the business is expected to receive, and hence in the balance sheet we will deduct our provision for doubtful debts. That in this example we have bad debts inside the trial balance of 1,000, trade receivables showing of 15,000. Now out of this 15,000, they say that 2% of the trade receivables may not be received, and they want us to show it as doubtful debts. So let's look at the income statement. In the income statement, if you see under expenses, first bad debts is picked up from the trial balance. Apart from that, we need to show additional 2% of the trade receivables as doubtful debts. So when I take 2% of the trade receivables, 15,000, I get $300. This is additional amount over and above the $1,000 bad debts, which will be shown as an expense. What is the difference between bad debts and doubtful debts? Bad debts is a confirmed amount that you will not be receiving anymore. Provision for doubtful debts or doubtful debts is an estimated amount that we may lose. We may not even lose. Next year, we might actually not lose this amount, and the customer may pay us. In the balance sheet, trade receivables is shown at 15,000, but we'll have to deduct our estimated amount that is not going to be received, which is doubtful debts, and show the final amount, the net amount as current assets in the balance sheet, which is 14,700. Now this was about creating new provision. What if there is existing provision in the trial balance and we have to increase the provision? So let's see. Now if you see the trade receivables is showing at 20,000. Provision for doubtful debts is existing at 300. This is from previous year, brought forward from previous year. They tell you that maintain the provision for doubtful debts at 2.5% of the trade receivables, right? Meaning trade receivables showing at 20,000. You need to maintain the doubtful debts at 2.5% of that 20,000. So when I calculate 2.5% of 20,000, how much am I getting? I'm getting $500. But what is my existing provision? Only $300. It means there's a shortage of $200 in my provision, which I need to increase. Whenever you increase your provision, it will obviously be an expense for the business, and hence in the income statement, $200 will be an expense. Okay. In the balance sheet, out of the 20,000, 2.5% of it or $500 is doubtful. Hence, we'll have to deduct that $500 from the trade receivables to show the debtors at net amount of 19,500 as current assets in the balance sheet. Okay. One important rule I'll tell you about doubtful debts. The change in doubtful debts always goes to the income statement. So the change in doubtful debts goes to the income statement. The closing balance of doubtful debts will always go to the balance sheet. Here the change is $200, income statement. The closing balance of the doubtful debts was at $500, balance sheet. Now in this one, we are trying to decrease our provision. The business already has provision for doubtful debts, but in the current year, that much is not required. The doubtful debts estimate has reduced. So let's look at the example directly. Trade receivables showing at 24,000. From the previous year, we brought down a provision of $500. In the additional information, they say that 2% of the doubtful trade receivables, current trade receivables, they need to maintain as doubtful debts. So in the income statement, okay, before going to the income statement, let me show you the calculation. Now, if I take 24,000 into 2%, what I'm getting is $480. I need to maintain a provision for doubtful debts of $480 at the end of current year. But how much have I brought forward from the previous year? $500. This means that I'm already holding extra $20 as provision for doubtful debts, which is not required anymore. So when I wanted to create provision for doubtful debts, or when I wanted to increase provision for doubtful debts, I charged that amount as an expense in the income statement. Now when I don't want the provision for doubtful debts, I want to reverse it. I want to reduce the provision for doubtful debts. Obviously, that amount will be treated as an other income. And hence in the income statement, we've shown this amount as an other income, the reduced amount of $20. In the balance sheet, I told you, always show the closing balance of provision for doubtful debts deducted from the trade receivables to show the net amount of trade receivables as current assets in the balance sheet, and hence 24,000 minus 480, net amount is 23,520. Now our next adjustment is on depreciation on current assets. Depreciation in detailed videos have already been uploaded where we've seen the methods of depreciation calculations, how to do accounting for depreciation. Here we're just going to see the treatment directly in the financial statements. What is depreciation? Depreciation is the fall in the value of an asset, of especially a non-current asset. Now when a value of non-current asset falls, it's a loss or an expense for the business, and hence the annual depreciation will be charged as an expense in the income statement. In the balance sheet, we will have to show our non-current assets at the net book value after deducting the current year's depreciation. So let's have a look at the example. We have two assets here, machinery and equipment. We are going to use both the methods, straight line method and reducing balance method, and see how do we treat it in the income statement and balance sheet. Machinery, cost of the machinery is 60,000. Provision for depreciation on machinery is 15,000. For equipment, the cost is 35,000 and the provision amount is 14,000. Having a look at the additional information, we see that machinery is to be depreciated using 20% rate and reducing balance method, while equipment 10% rate and straight line method. Let's do the calculation first and then go to the income statement and balance sheet. If I do machinery depreciation, which is 20% reducing balance method means rate into net book value. So my machinery depreciation will be rate into net book value. Now what's my rate here? Obviously 20%. What's my net book value? Cost minus accumulated depreciation, which is 60,000 minus 15,000 accumulated depreciation. Accumulated depreciation is nothing but provision for depreciation. So if I take 60,000 minus 15,000 into 20%, I will get an amount of $9,000. This means that this is the annual depreciation on machinery. Same way if I do for equipment, it is straight line method 10%. So rate into cost. My rate is 10% and my cost of the equipment is 35,000. So that gives me 3,500 annual depreciation. Let's have a look at the treatment in the income statement first. In the income statement, my annual depreciation on machinery 9,000 goes here as expense, and on equipment 3,500 as expense, again in the income statement. Now in my balance sheet, many students get confused here in the balance sheet. See, under non-current assets, I need to show these details for every non-current asset I hold, which is the cost of the asset, accumulated depreciation and the net book value. Now under cost of the asset, obviously we'll pick it up from the trial balance, machinery 60,000 and equipment 35,000. But for our accumulated depreciation, now the provision for depreciation shown in the trial balance as 15,000, that's the previous year's depreciation, accumulated depreciation till the previous year. We've provided additional 9,000 depreciation in the current year. So what will be the accumulated depreciation in total considering 15,000 and 9,000? Obviously this 24,000 will be 15,000 until last year plus 9,000 current year's depreciation, so total 24,000. And that's how we get 24,000 accumulated depreciation. Net book value will obviously be 60,000 minus 24,000, 36,000. Same way for equipment cost at 35,000. Accumulated depreciation. Until previous year, our equipment accumulated depreciation was 14,000. This year, we've provided additional 3,500 depreciation in the income statement, 17,500. When we deduct that 17,500 from 35,000, our net book value is at 17,500, and then we'll have to show a total of all these amounts. Total cost 95,000, total accumulated depreciation 41,500, and total net book value 53,500. So this is how you present your depreciation and your non-current assets in the income statement and the balance sheet. And our last adjustment, finally, we have stock drawings. Now, what do you mean by stock drawings? Stock drawing means goods withdrawn by the owner for personal use. The goods that were actually purchased for reselling in the business, the owner has withdrawn them for personal use. Now, see, when the owner withdraws goods for personal use, the amount of goods available for sale reduces, and hence the revenues have reduced. Matching principle requires us to match our costs properly with the revenues. Since our revenues have reduced to that extent, we also need to reduce our cost of sales to the extent of goods withdrawn for personal use, so that our gross profit is correct, so that our calculation of gross profit does not suffer. And hence the cost of the goods that are withdrawn for personal use will be deducted from the cost of goods sold. Like you deducted the cost of unsold inventory at the end of the year, same way we'll have to deduct the cost of goods withdrawn from the cost of goods sold. Since this is a drawing, amounts withdrawn for personal use or goods withdrawn for personal use is a drawing, this will be reduced from the owner's capital on the balance sheet date. So deduct from capital in the balance sheet. Now in this trial balance, we have opening stock, we have purchases, existing drawings 8,000. Apart from this, we have a closing inventory of 25,000, and we have stock withdrawn for personal use 2,000, stock drawings of 2,000. Now in the income statement, let's see what happens. We'll record our revenues. When we're calculating a cost of goods sold, we will have to take up stock drawings, reduce it from the purchases. Now this stock drawing of 2,000 is already included in the purchases. But since this was not available for sale, we will have to reduce this amount and show the net amount that was available for sale. And that's why it is reduced. So we reduce 2,000, we reduce also 25,000. And eventually we get cost of sales 86,000. Compare it with your revenues to get the correct gross profit. In the balance sheet, this 2,000 will be added to the existing drawings of 8,000. Here in the trial balance, 8,000 is there. This will be added to the existing drawings of 8,000. So hence total drawings of 10,000 will be reduced from capital to arrive at the ending capital on the balance sheet date. So these cover all major adjustments that can be asked in your exam. I hope now you would be able to solve questions related to this topic better. If you've enjoyed this video, if you think it was useful, please like it, please share it with your friends. Thank you.